Do you see any way, we talked about the AI being a platform shift, do you see it transforming marketplaces in any way?
Do I see AI transforming marketplaces? Absolutely. So I think that's the thing is I think we had a marketplace wave and boom with Web 2.0 and mobile with this Airbnb, DoorDash, Instacart, Uber, all these companies, and Yelp. I think now we're going to see the AI wave of marketplaces. But since it's not this obvious hardware platform, like we said, it's more like internet, it's more nuanced. People still are figuring out how intelligence creates this platform. There's the obvious use cases that everyone has now, but there's all kinds of use cases we haven't thought of yet. I think it's not obvious yet. It doesn't fit into a cookie cutter box the way there was a while where it was just Uber for X. And you could just do that in every category. And that kind of worked. Like Uber for food delivery was DoorDash, Uber for grocery delivery, Uber for homes is Airbnb, Uber for cars was Turo.
Hey everyone, welcome back to the Ignite podcast. Today, we're thrilled to have Mike Ghaffary on the program. He's general partner at Burst Capital, a veteran investor in marketplaces, AI, and software. Before Burst Capital, Mike was GP at Canvas Ventures and Social Capital. Very cool. He's also played a pivotal role at Yelp, where he led BD and corporate development, later became CEO of Ep154, growing it to a 700 million food delivery marketplace. Awesome. He's also a co-founder at Stitcher. I've heard of those guys. Podcasting platform acquired by SiriusXM. He's also invested in some pretty famous companies like Strava and Fair and Superhuman and Cloud Kitchen and Optimizely. I remember using Optimizely actually back in the day as a growth hacker, so that's awesome. We'll dive into his journey, lessons from scaling companies, his outlook on the next big tech trends. Thanks for coming on, Mike.
Yeah, thanks for having me. Excited to be here.
Probably one of the most impressive people I've had on the program. I was reading your background and I was like, wow, this is pretty amazing. So thanks for coming on.
Well, I'm honored. Thank you for the compliment.
So you started your career as a software engineer before pivoting to VC and startups. Like, what sparked that transition?
My software engineering career was very, very short-lived. I was a computer science major in undergrad. I actually first started coding. I learned software because I wanted to be able to crack games. There used to be this copyright protection. You had to jump to, I'm dating myself, but you had to say what was on the bottom of 12 page in the instruction manual of a game you were playing to show you didn't just copy the disk or borrow from your friend. And then it was a fun puzzle to me to learn assembly language at it was around age 12 or 13. So I started learning programming then. I then learned C++ and stuff. And I studied computer science in college because I liked programming almost as a hobby and for fun. And I did software engineering during undergrad. I worked full-time at a couple of companies while I was in school. But once I graduated, I said, you know what? I'm much more interested in the business of technology than just staying up all night writing software myself. I want to just get more leverage and see more ideas, see more business models. I got really fascinated with that. So I made the change. After I graduated, I did not do any full-time post-school engineering jobs.
Amazing. I kind of came from tech almost the opposite way. I started in finance and business and got progressively more technical through my career.
There you go.
Almost becoming a data scientist at one point, but that's amazing.
Well, I just built a little app for fun with myself on Replit. I mean, now with vibe coding, we can all just go back to engineering really easily.
Yeah. Yeah, you just have to speak to the AI now, which is pretty amazing.
Yeah.
So Stitcher was way ahead of its time for podcasting. What was the initial vision there and how did it evolve over time?
Yeah, we caught a really good moment right as the iPhone was launching, although, we were still, I think, in the long run, obviously early to the market. It was the early days of podcasting. And I think at first the realization, and my co-founder, Noah, he kind of, had the original concept. He was actually had a few different business plan ideas. Had started my investing career way back then before I did Yelp and Stitcher and all that. I was at Summit Partners and I was advising him through, a few different ideas. And he had the Stitcher idea. I was like, wow, that's a really good one. You know what? And then he's like, why don't you come with me, and kind of recruited me to come over as his co-founder. And the idea was, hey, you're driving every day. There's X amount of minutes commuting. This is obvious to a lot of podcasters now.
And I used to use it. This is back in the early 2010s.
Yeah. I mean, that's when it was taking off. It was founded. Company was founded in 2007, I think, and then that's when I joined. He was working on it maybe a little bit before that.
I think it was one of my two primary audio apps at the time. I think it was Pandora and Stitcher.
We were the only podcast app. When the iPhone app started, there was the Apple podcast, and then nobody else. Spotify didn't have podcasts, Pandora, anybody else, and there was just Stitcher, and we were the first dedicated app. So the idea is you've got all this time on your hands. There are all these great podcasts, but they're mostly locked up at the time on you have to go download them from RSS servers. It was actually really hard to get the podcast. So we realized there was a distribution advantage that could be built and a better consumer experience. The idea was literally stitch them together. So that's why it was called Stitcher. Stitch all the different podcasts together. There was a fun story because at first we just had Stitcher without the E, Stitch R. People couldn't spell it. It was really hard. but there was a German tailor, Mr. Sticher in Germany, who had the Stitcher with the E, the domain name. He didn't speak any English. So I had to negotiate with this guy. I was like calling Germany early mornings trying to convince this guy, please sell us his domain name. And eventually, I think for like 10 grand, we were able to convince him to hand it
Nice.
over, which was
It's
nice.
like a scribed or scribed,
Yeah,
that
that's exactly
became
what I was
ever.
thinking of.
Yeah.
Totally.
It was like, and I snowboarded with the CEO in Utah. I just happened to meet him at like some VC retreat.
Yeah.
And it happened to be the CEO. And I'm like, that was really confusing, right? And he goes, yeah, that's
Yeah.
why I changed the name.
That's funny. I think lives in my neighborhood now. He now has an AI startup.
Yeah. Yeah, that's right. That's amazing. And then, so when you say early to market, this is interesting. As an investor, this one of the things we constantly try to rack our brains around is like, is it the right time? So like in hindsight, what did you learn about it being too early to the market, and how do you kind of spot that going forward as an investor?
Yeah, look, I think as a seed or even Series A investor, it's actually very hard to know because you're betting on some trends and you're betting on the timeline they'll play out. I think the key is you have to assume that whatever product you're betting on is ready for mass adoption in like 7 years. Hopefully, even this year and next year, and over the next kind of 1 to 5 years, there's going to be a big rapid adoption curve. But those first couple of years at seed and Series A, you're betting on early adopters. You don't need it to be mass market yet. But the problem is, if you get to that 7-year point, and so for us, like starting in 2007, we were betting by 2014, yeah, it's like everyone's going to just be listening to podcasts all the time on their phone. I don't think that was a crazy bet back then. I think it was really hard to know. What happened was there was so much attention around YouTube and videos and video content with the early launch of the iPhone. I think we couldn't have really fully anticipated that. And then music really took off as audio, but this podcast spoken word audio just didn't have its moment yet. Only recently, I would say, really, really took off where that's become a much bigger market. But what's interesting is there still hasn't been, that I know of, like a dedicated podcasting company over $1 billion. That still hasn't happened. There's Spotify.
It's such a red ocean, right? You have Podcast Addict, you have all these open source ones, and then you have the big aggregator ones like Spotify,
In
YouTube
video,
Music.
you've got YouTube and video, you've got Spotify and music, and they kind of bolted it on. But it's like, why doesn't podcasting? And there might be something that happens, right? We'll see. Clubhouse was really interesting, that ran up to like a $4 billion private valuation. Obviously now they haven't kind of maintained that, but so there's still something there, and one day someone's going to crack it. But look, I think sometimes you have to ask yourself, can this market really bear? As an investor, we're all looking for $1 billion plus companies. Can it bear? And the answer for at the time, and still kind of was for podcasting, not yet. But I don't know. If I could go back, it was really hard to identify that at the time. So we take a swing, and then we at least had a reasonable.
Is pretty good.
But that wasn't the first sale. So that was a repeat sale. As founders, we really didn't, make very much. The next owners, the company was sold a couple of times.
Yeah.
So if we got 300 million out of the gates after 7 or even 10 or 11 years, I think we would have been very happy. But that's not exactly how it happened. So it was good moral victory, though.
Yeah, to actually exit and build a brand. I mean, people remember that, and I don't know, like when it topped out, what was your MAU and WOW and all that stuff?
I don't have what the peak numbers were now, but yeah, we had pretty big reach, and that's why some of the acquisitions made sense too, because then it got to a bigger audience. First with Deezer, and then now with Sirius, it like became a big part of what they do.
That's why I kind of stay away from consumer apps, and one, I've never really built a successful one, and two, they're really hard to get right.
Yeah.
And when I look at something, I'm like, okay, why won't the incumbent just bundle this in and make it free and more fully featured? Like Google's going to come in, or Spotify or Apple, or somebody's just going to come in and go, oh, yeah, that's great. I like the reels, and Mark Zuck it right into Instagram.
Yeah.
It's a really tough business.
I mean, it's interesting though, but if you look at the Magnificent Seven, 4 of them at least, right? Like Google, Apple, Facebook, Meta, and Amazon are all consumer. And then even, and then Netflix used to be in the Magnificent Seven, or in the FANG at least, before kind of NVIDIA replaced them. So Tesla is, selling cars to consumers. That's kind of clipping on the heels of the Magnificent Seven. If you look at the top public companies and even the tech companies created in the last kind of 20 years, the consumer ones can really take off. But I hear you. I've shifted my investing. I skewed a little more heavy consumer early on, but now, just because where the entrepreneurial energy and attention is, it's probably 70% enterprise software, B2B, and AI and other areas. And then, maybe 20, 30% marketplaces and consumer. That's where a lot of the attention is, but you've got to be contrarian investing. That's why I'm always open-minded to, even though there's these amazing AI and software companies, like one I'm really excited about right now is OfferFit. You mentioned Optimizely at the start. OfferFit, it took my Optimizely thesis and it's like Optimizely on steroids, doing, in marketing tech, doing not only website optimization, but taking it to the next level of optimizing all your marketing communications using AI. It's really interesting. That's like a great B2B company. So I'm very excited about all these B2B opportunities. But I think if you can find a consumer idea or a marketplace and be right now, then there is potentially there could be Google size opportunities, Facebook size opportunities, or even don't forget Airbnb, DoorDash, Uber, and some of the smaller ones like Pinterest, Lyft, and of course Yelp. So when consumer works, it can really work. We just need a new platform. And so the question is AI finally the consumer platform? I kind of think it is, but the rush of consumer AI hasn't really fully taken hold the way. I think there's going to be a big wave of consumer AI that we'll see. That's my prediction.
That's really fascinating. So much to unpack there. One of the things is a platform shift. I'd love to tug on that thread a little bit, right? Because, you had the iPhone, 17, 18 years ago, and that was a platform shift, right? This mobile first, and it basically made all these new decacorn and accumulated a lot of value to the incumbents like Google. And then the question that you kind of pose is like, it seems to be an AI platform shift now. And I wonder how that holds. You have this new compute layer of foundational models enabling all this innovation. But yeah, what form does that take in enabling consumer apps? One thing that I've noticed, and I'd love to get your thoughts on this, especially on the B2B side, this isn't consumer, is that AI is actually replacing labor now. So as I evaluate businesses, they don't even look at behave like a SaaS business really. It's almost like a AI agency business or an AI enabled service. One of our startups that's grown fast is called CollectWise, and they use AI to collect debts. Huge multi-$10 billion, $50 billion industry that, they farm out to the Philippines or wherever, and people just call people and just try to collect debts. And now AI can do that at scale 24 hours a day. And it's not really a SaaS business. It kind of is. It's like AI as a service, ass business. I think I've said it before, but that's like the nature of software is kind of changing in a way. It's still there. I mean, I'm sure they still have a SaaS platform that you can log into as a customer, but the way the work is done, like it's almost as if SaaS is still there, but now it's like this new layer of intelligent cognition doing work. Are you investing in any businesses like that? Like, have you seen anything like that you're excited about?
Look, taking a step back, because I think you're right. It's a harder platform shift for some people to get their arms around, because historically it's like, oh, there's a PC revolution. Okay, let's write a bunch of consumer apps and B2B software on the PC. Oh, there's a mobile phone revolution. Oh, let's write a bunch of consumer apps and and B2B stuff that uses this mobile phone. And then there was the internet in between those two. And that was not a new hardware platform, but it was like, oh, there's this high-speed communication. Let's make these websites that can, take advantage of that. And so it's probably that AI is a little more like the internet, right? It's not a hardware device. The iPhone made it so dead simple to see how there was this platform, there's an app store, like there's an app store, build your app, go. Like it was just so straightforward. There were a bunch of companies like Airbnb and Yelp that caught great timing that we started like right before the app store, and then you could launch in the app store and just ride that wave. A bunch of, app store native companies like Uber that just started because that app store existed, allowed them in those phones everywhere, allowed them to work. But that was just so obvious. So now with AI, it's like, okay, there's not this obvious app store. OpenAI has tried things like that and others could. There's not this obvious hardware platform. But you're right, there's this compute platform. But much like the internet, it's like we're not 100% sure. You're asking the right question. We're not 100% sure what's the modality that unlocks this Cambrian explosion of all these new companies, right? We're seeing a lot of it already. Don't get me wrong. There's already been this big explosion, but there can be even more. So is it like agents? Like that's one obvious one that everyone's looking at. And that's kind of what you're talking about are there all these agents working for you? Is that maybe the thing? Is someone going to build an agent app store? Is there going to be more of this walled garden? Or, the internet, there ultimately wasn't like the big app store. There was AOL and people who try to kind of, route your access, but ultimately the open internet one. So is there actually this open model where there's not one walled garden from one company, I think part of that will depend on how much the foundational models do or don't have a competitive lead and differentiation. Like if OpenAI, for example, truly becomes the better mousetrap, where they were head and shoulders above everyone. There were times where we thought that might be true. I would say now it's probably pretty unclear, right? So like you got Gemini just came out with a great release and everyone's talking about it.
A 2.5, yeah.
Yeah, everyone's saying Claude is the best for coding right now. So it's like, it's hard to say, but then OpenAI just did this image release, and certainly for Studio Ghibli style images, we know, and you know, they've got great image generation right now. So if someone gets the runaway lead, they're in the position to create a walled garden around them, just like Apple was able to create a walled garden when it got the runaway lead in mobile phone internet hardware. But if not, then you could see a more open intelligence revolution, right? But again, so when you go the walled garden method, they control the modality. So if OpenAI did it, let's say, they would be like, we have an app store, we have an agent store, these are the rules, maybe we take a cut, go, and there would be a bunch of innovation. If it's open, it's more confusing. If you remember with the internet, at first there was FTP and go over the Usenet, and it was like, oh, okay, is that what this is about? And then it's like, oh no, there's the World Wide Web. Is that just like a toy, or is that interesting? And then, oh, there's a browser and these browser companies. And then finally it started to take off. And then search engines became the killer app. There were like a dozen search engines and Google took off. So it's like it kind of evolved in different layers. And there was Web 2.0. We might be talking about AI 2.0 not long from now. AI 1.0 was a lot of B2B and some agents and the foundation models. But now it's AI 2.0. And if, Web 2.0, it was so hard to predict that things like social media and, Yelp and some of this other UGC was going to take off. You didn't really realize that. So we don't even know what this AI 2.0 class of companies might be. But I'm confident in saying it's probably going to be a pretty big new field that's going to exceed our ability to even imagine it right now.
Right. It's kind of like trying to talk about mobile in 2008. It's hard. Like, yeah, there's this app store. What does that even look like?
Yeah.
And I don't think anybody could have predicted how big it would get. And, I think thinking about PC revolution, Windows kind of won, right? And that's kind of a walled garden, kind of an open walled garden, like a platform with APIs and stuff.
Yeah.
And then you had the internet, which was like kind of built on top of that, which was this wild, wild west of everything.
Totally.
And then along comes like, cloud was a little bit more closed, a few big players, a few big winners, and then mobile was very much like two big winners, walled garden. So yeah, maybe kind of history kind of repeats in a way.
Yeah. Well, history rhymes, it doesn't repeat is the same.
Right. I love that.
I think we're going to see, but the question is, what does this rhyme most with? I think it rhymes most with the internet so far, right?
Yeah.
More so than mobile or PC. And so that means it's very big. It's going to have multiple waves. It's going to have a couple of crashes too, right? And so we'll see what those corrections look like. But when we get on the other side of all of that, it's going to be probably bigger than most people even expect now. And people already have very big expectations.
Yeah. I don't think we've reached a bubble point yet. Like, I don't hear people saying this time it's different yet. That's the old phrase. That's when you really know it's a bubble. When people are like, nope, this time it's different. It's going to, this is like 1999, right? Internet's different. This time it's different.
Definitely a lot of bubbly indicators, but yes, people still remember the recent history reasonably well.
Yeah. Are you getting in and maybe you could talk a little bit about your thesis so we can dive into kind of present day a little bit, just jumping straight.
Yeah.
Yeah.
So I'm a general partner at Burst Capital. Burst Capital was founded by all original Yelp executives. So my partner, Jeff Donaker, was the original COO of Yelp, took it from 0 to $1 billion in revenue. We also have the CFO of Yelp, originally Rob Krolik, who took us public, Wendy Lim, who was VP of operations and all kinds of other functions. And I ran corporate development, business development, like you mentioned, Ep154. So we all bring different disciplines to the table. One thing we're really interested in is in these Main Street tech businesses. We take Main Street broadly defined, everything Yelp touched and beyond. If you go down the categories that we saw, outside of just pure finance or pure tech, you've got home and local services, restaurants, health and beauty was a big category for us. So doctors, dentists, lawyers, auto, there's all these different categories. They actually make up 46% of the US economy. So it's about half the US economy is this Main Street. So we're very interested in how Main Street intersects with technology and AI. But also, half of our investments might be other kind of things. Like, we invested in, OfferFit that I mentioned, AI company, SourceGraph, right? That's one of the number one developer tools for code searches. Actually, at Yelp, it's the most popular code search tool. That's how we kind of got that thesis. So we're not limited to the Main Street, but it's definitely a power alley for us. And we have a lot of great winners. We've done really well there, like Indigo Fair, which is now called Fair Wholesale. We were, both Jeff and I were kind of first money in very early rounds there, small check, and that's been a great one for us. Next Insurance that recently exited is another portfolio company. They're serving SMB. Owner.com serves SMBs. That company has grown incredibly quickly. So those are some examples. And obviously, people are very familiar with the last wave of these Main Street businesses. I mentioned some of them: DoorDash, Airbnb, Uber, Lyft, Yelp, all these companies, right, that kind of straddled Main Street and technology. I think with AI, we have yet to see that big wave, and it's coming. So I just made one of those investments called Hosty, where it's an AI voice agent for restaurants. That's really interesting. And I think that's going to be a trend that you're going to see take off in a lot of different places. That's kind of the high level overview on our thesis and what we're looking at.
I like the Hosty one.
AI software and marketplaces.
Yeah. And what stages, sectors, geos?
Yeah. So we're
we talked about the sector actually,
focused,
but
although we have looked, never say never. We've looked a little bit internationally and done a few internationally in special situations. We're largely at the seed stage where we'll come in, but we'll also join Series A's where we think we have a special insight. And a Series A investor we know really well is bringing us in folks like Jeremy Levine at Bessemer Ventures, who was on our board at Yelp, or Jeff Fleur from Craft Ventures. He was chairman of our board at Stitcher and is also very close to the rest of the Burst team. So if someone like that, who we know really well, is leading an A, and they say, hey, Burst can participate, we can add a ton of value for a very small amount of space on the cap table. So that's why they'll bring us in, all former founder operators. And so we'll jump in and help there also.
That's awesome. What's typical check size? Are you guys leading? What's the fund size? How many investments? Stuff like that?
Yeah. So we've got about 25 core investments per fund is what we target. We're on the second fund now, but then there's 20 to 25 additional investments that are non-core that might be smaller checks. For the core investments, those can range from $750,000 to $1 million. It can go a little bit higher than that sometimes. It can certainly be lower. And so at that check size, we're certainly not going to lead at Series A. At seed, we might be co-lead or the largest check lead, but we're set up to be very collaborative, where we want to be able to work with other venture firms, other seed firms. And so we do have a lot of these other co-lead and other leads that we work with very successfully, and we're excited about that.
Yeah, and I have to look through our portfolio to see if we have any overlap. I'm sure there's
something there.
There's got to be something. I have 189 now and counting startups, so we're very high volume.
Yeah, awesome.
I just like chaos. I just like chaos as much.
I think I listened to an interview you did with an LP where you talked about your theory on the Monte Carlo simulation, the right number. That's obviously always people like to model that up.
Yeah, I don't know. Like I go back and forth on this, right? Because investing in 150 startups a fund is a ton of work. So I could see, the benefits of concentrating.
Sure.
Especially as you get better at this. And I've been toying about thinking about this for Fund 4 coming up next year. And so far we've raised very small funds in 1, 5, and 10. And so do I do a little bit more concentration? Do I go even higher volume with the larger team? I've been kind of toying with that. Are you guys taking board seats?
No, we're not taking board seats. So I'm still an advisor to Canvas Ventures. I'm the prior fund I was leading deals with, and I have board seats from there, but I'm trying to not take new board seats. We have on occasion at Burst do it, but generally it's not the strategy. Kind of more founders funds, they're doing it on much bigger capital, have that strategy of trying to not do the board seat and be super helpful outside of the boardroom at inflection points and because we're all operators. So it doesn't mean we're not spending a lot of time with the companies and really digging in, giving operational help. But we actually feel like sometimes you're able to do that more effectively. It's nice, if the board member is like the parent that you have to go to and check in with, we're kind of like the uncle and aunt, right? And you come to us when maybe there's something you can't discuss with the parents, a new crazy situation, and we can really zoom in and be helpful.
Yeah, I like that analogy. And are you getting board observer status in some cases then?
We have different, like information rights and things that'll come up, but we don't see that hey, we need to attend board meetings as director observer as a big part of it for us.
Yeah. I love that.
We've been in enough board meetings, all of us, for a lifetime, just through our careers. We've all been working together one way or another for over 15 years. And so we've kind of checked that box on going through a lot of board meetings.
I have no desire to go to a board meeting. Yeah. I've had founders ask me hey, you want to come be on the board or you want to be a board observer? I'm like, no, I don't have time.
Yeah.
But I can, elect some people on Team Ignite in my place. I could recommend some people, but I don't think you want me there. I'll probably mess things up.
That's definitely something founders have to be careful about, is VCs on the board messing things up.
Yeah, like I'm not a successful $1 billion founder. I know that about myself. Like you want somebody who's been there, done that. Like I've just built a bunch of failed products. I know what good looks like because I've never built it.
Yeah. There you go.
So you led partnerships at Yelp and became CEO of Eat24. What was that transition about? What made that happen?
Yeah, it's a good story. So at Yelp, we realized like, hey, all these people are coming to our platform to find all these local businesses. What if they could transact with these local businesses? And we said, let's build a Yelp transaction platform. And that was run out of the BD team that I was working on. And so we launched this Yelp transaction platform. We did multiple verticals. You could book, hair salons, or there was like golf tee times. There's all kinds of stuff. But we knew that hotels. We partnered with Hipmunk, if you remember that company. Actually, one of the co-founders of Reddit, Steve Huffman, was also a co-founder there. And so for booking hotels, but restaurants, we realized would probably be one of the biggest, if not the biggest category for us. And we started working with food delivery partners. And one of those food delivery partners was a little company called Eat24, founded by a handful of guys. When I think I first met them, so we partnered with them. They were, doing less than $1 million revenue. They were small. They were like 5, 6 core founders, and they had a small team around them. And we partnered with them. And over time, we're like, wow, this little company is by far our most successful platform partner. They iterate so fast on product, really scrappy guys, not your traditional founder background. None of them went to any Ivy League schools or worked at Google or were former product managers or anything. In fact, the founding CEO was working at a pizza joint as his last job.
Oh my God.
The idea. He had been selling like glass tables or something online. He had like dabbled his feet in the internet, just self-taught. But he came out of the Israeli Navy, and moved to the United States with like no formal training.
Something in the culture there. Like, what is it about Israel?
That was all an Israeli American team, like recent Israeli immigrant founders and super entrepreneurial, great guys. We're all, become dear friends through this whole process, both partnering. And so, one day we're like, this is our most successful transaction platform partner. And then we realized we were their number one source of new users. And we started thinking about making an acquisition, in this area. And so we talked to him. And then I remember I had my line. I told him, I said, hey, Nadav, the founder, I said, I never want to read one day in the Wall Street Journal that you sold the company and you didn't call me. Like, make sure you tell me if you ever sell the company. And then one day, Mark Benioff emailed me. He was like ordering a lot on our platform and stuff, the founder of Salesforce. And he said, hey, can you introduce me to the Eat24 guys? I said, sure. And I didn't have the full context. So I made the intro. I asked them, is it okay? They're like, of course. And then a couple of weeks later, they're like, that intro you made us? Actually, that's leading to M&A talks, not from Mark, but someone Mark introduces to. Wow. Wants to buy the company, maybe. You said to call you. I'm like, yeah. Don't sell the company without, talking to us. So we kind of went into an M&A process and we decided we wanted to acquire this thing. We looked at some different options and we acquired. The rest is history. So by the time we acquired them, it had gone from very little to 150 million in gross transaction volume.
How fast were they growing? Do you recall?
Yeah, extremely fast. If you think about it, that was just over the course of a few years. They went from, a couple million in GMV to 150 million. They were like more than 10xing early on. By the time it got to like the acquisition time, we were in the 3x. So I can give you one growth metric in 2 years. The first 2 years while I was kind of CEO of the subsidiary Yelp24 of Yelp, we went from 150 million to about 750 million for our annual run rate GMV. So that's like a 5x in 2 years. That's a little less than a 3x annual, but pretty fast growth. So it was an amazing experience. And the founder, he told me, he realized, I told you his background a little bit during the acquisition process and we're negotiating. He's like, look, Mike, I'm not a corporate guy. I'm not going to last very long inside like Fortune 500 type companies. That's not for me. He's like, we do. He's like, you got to find someone to kind of run this. And then we went, and then he asked me, can you do it? And then simultaneously the Yelp board and team said, hey, Mike, can you do this? And it was actually a career change for me. I saw myself as a deal guy. I kind of figured I might go back into VC. I'd done VC before. I might go back. So I was like, oh, do I really want to do this? It was exciting, though. It was like hard to pass up. And so I took on the challenge. And a couple of the co-founders stayed on because they did want to be corporate guys and learn how that worked, but they weren't really CEO. I got to work with them on the team, and it was really awesome.
What an amazing story. There's one question that kind of popped up in my mind as putting our VC hats back on from that story is, how do you think about, it's pretty easy to invest when the company's growing that fast, right? When you see a company, growing 100% a month or 50% a month, and they're doing it consistently for 6 to 12 months, you're like, just, can you send me the safe? It's like, send me the safe.
Going right here.
Yeah, things are going right.
Yeah.
How do you think about, so you definitely want to be in the right place, right time for companies like that. And some of my biggest breakouts have been exactly that. It's just like you look at the metrics, it's like clearly these guys are going
Yeah.
places. And how do
Yeah.
you think about when you don't have that, right? Maybe it's a little bit pre-product market fit, but there's like I don't know, like an amazing team. You probably wouldn't even be talking to them unless it was an amazing team. How do you kind of underwrite that bet and sort of think in probabilities of like, okay, I'm going to make this bet even though the metrics aren't there yet?
Well, it's especially important now for a few reasons. One, somebody from Benchmark, I think, is maybe Eric Vishria had said this last year of like, be careful getting too drawn in on the early revenue some of these companies are showing because it's kind of easy. You might at Series A all of a sudden, like, look, we have all this revenue, but it could be easy come, easy go. And there's a lot of talk about some of these hyperscaling early
I've
AI
heard that kind of percolating that this revenue is not
testing
sustainable.
revenue, right?
Yeah.
And so what's the churn on that? So you do have to be really careful because even that traction could be misleading. Nonetheless, for those companies growing that fast, I'd still probably want to be invested in. But that's one thing. Another thing is, just from a valuation perspective, like if you're trying to get in at seed or early, if you wait until it's obvious, it might be too late at that point as well.
Yeah.
So that's kind of what
Now they got $1 million of ARR and they're raising at 100 cap. You're like,
yeah.
oh gosh.
Yeah. So you got to, exactly. It's a 100 times revenue multiple, but if it's growing fast enough, that's, that might be the case. I just looked at one, I actually did a small check, kind of can't announce it here, but on that was pre-revenue and raising at 100 million. But they had so much usage. They had an explosion of usage, like in the developer community.
Wow.
Made that obvious to people. So look, I do think some kind of proof points of this working. At Burst, we don't do a lot of what I'd call pre-seed. People say these terms are made up, but I think pre-seed has carved out a place of like, hey, when you're still an idea, we're really like pre-product market fit. There's no real sign, maybe pre-launch, and it's just that early. I think that's a tough place to invest. And I think at that point, you're making team bets, you're making technology bets, you're making market bets, maybe first and foremost. And it's a different kind of investing. Obviously, later stages are maybe all about much more about the traction, like growth investing. And then seed and Series A are kind of in between.
It's an art and science, right, where we live in this kind of late seed territory, right?
Yeah. And I think we do want to see some traction and launch. Some seed investors don't need that, and we make exceptions. But usually we do want to see that, hey, there's some signs that this is working. You've got whether that's revenue or user growth. You're figuring something out, and we're going to help you really pour gasoline on the fire, really grow this thing. That might be through helping your go-to-market. That might be through helping your user growth and your growth marketing, or, and even at Yelp, we were doing things like events and offline marketing to grow, trying to get you outside of the tired channels that everyone else is using. But I think ultimately, to answer your earlier question of like, how do you assess it when the metrics are murky? I think team and market are the most important, because at these early phases, product does change, but it's really like, is this the right team? And are they swimming in the right, like a big enough market? I think Anne from Floodgate once told me, like, she said, people put out data. She's like, some of our worst passes when we miss something is because we passed on market, because the market can grow. So you can't define the market as the market just is today. You have to not only say, what's the market, but what's the broader context they're in? What could this market pivot to? I do think it's important to take that broad view and assess market, because there are examples I can think where I've passed because I said, hey, this is just too small of a market. It's just not going to work. Amazing founders. I can think of one now, and sure enough, like 5 years later, I still love these founders. They're grade A founders, but they're still just struggling because their market is too small. So
yeah,
I think that happens all too often. I think that's one of the common rookie mistakes a lot of founders make, especially non-repeat founders. They don't realize how important they think like a $200 million market is a really great market. And I try to explain, like, look, if the biggest you'll ever be is 200 million, you can't even go public these days. And even if you could, let's say you went public like the old days at 100 million. If on your IPO in your S1 you said, we're tapped out once we double in size, we're just done with growth forever, that's super scary for investors. So not only do you need $1 billion market, you usually need 10 to 20 billion and up. So you can be big enough that even when you hit $1 billion revenue, you're still showing that there's a lot of growth ahead. And that can come through expansion and expanding your product offering and all that stuff. Anyway, swimming in that right market is really important. And then the founding team, just are they really ambitious enough to want to get that big? I think that's the other thing.
It's funny to kind of almost 200 investments in, and you learn a lot. When you take that many swings at bat, make a lot of mistakes. And it's funny. And what I like to say is, like, every startup's a beautiful snowflake, and you're trying to evaluate its unique crystalline structure.
Yeah.
And you're kind of looking at it like a piece of art.
Sure.
And, beauty is in the eye of the beholder, and everybody thinks differently about the same art. And sometimes it is just like it's an amazing team, but too small of a market. And you're kind of like, like you gave some great examples there. But sometimes it's like the right time and the right market opportunity, and the team's just okay. Now, before we continue, a quick word about an incredible resource for startup founders. This episode of the Ignite podcast is brought to you by Build, spelled BYLDD. So what is Build? Well, they specialize with early stage startups, especially non-technical founders and teams, helping you build and launch scalable revenue generating software fast and affordably. Most startups can't afford to drop 100K on some big design engineering agency. Freelancers are risky, inconsistent, and full of project management headaches. For 10K in about a month, they can turn your validated idea into a real market ready product. It's built for scalability. Past clients have been accepted into YC, Y Combinator, very impressive, received backing from Google, and raised multi-million-dollar rounds. And there's an exclusive offer for Ignite listeners. Get a free UI UX design sprint that's 3 to 4 weeks, a deep dive into your product experience, delivered completely free. This is normally a $10,000 plus service. So head to byldd.com, connect with Ayush and team, mention the Ignite podcast. Let's get back to it.
If the team's okay, it's just not. To your point, I've lived through from start to finish on so many of these billion-dollar companies and then so many of these misses. And it often, you could get very lucky. Sometimes it's the wrong team and then you hire a CEO. An interesting one, I led the Series A Cloud Kitchens, and that CEO really impressed me, and I led the Series A. I got excited.
This is Travis, right?
No, it's Diego Verdaken founded Cloud Kitchens.
Oh, Travis came in later.
And Travis was an advisor, much like Uber, right? Where you had Travis wasn't the original CEO, much like Elon with Tesla. So this model can work where some super ambitious person actually is your CEO that scales it. But Elon got involved super early and kind of considers himself the founder of Tesla. And if you're really
He basically had no revenue when he got there.
Basically, right? And then, or with Cloud Kitchens, like Diego had Travis as an advisor, and he's super a repeat founder, super smart and hungry guy. And we kind of told him like, hey, you might want to partner with a COO or a CEO. And like, who better than to build your company than you? Like, here you go, Travis, right? Like, he was like, that's great. Like, come in, be more involved. It was the best decision, right? Diego and everybody made. So it can happen that you might bet on someone else ultimately, but then you've got to have a founder that's so self-aware that knows their strengths and maybe where they could use somebody. And they're already talking about it. It was Diego's idea, right? Like to bring in Travis. Like that's great. That's very rare. Usually you're betting on the founding CEO themselves. And if it's not somebody who really can go the distance, and they can grow, they can be young. I mean, look at Mark Zuckerberg, right? Like they were betting on this college kid. But the ambition level, I think, for people who spent time with him, they were even at that age, I think they could tell like, wow, okay, this kid is really like, he really wants to build something big. And he's caught lightning in a bottle with the metrics were very apparent very quickly as well.
Right. So you got the tractions off the chart, the ambition and the founder.
Ambition there, even if he seems so green.
Yeah.
And then you can also do great. And we do a lot of repeat founders where you already see the ambition. And then the question there is, they get enough of the taste of success? They've got the chip on their shoulder. They want to build something bigger. But are they really motivated to build that bigger thing? Or did they get too comfortable? Because it's really easy to be comfortable.
Yes. Really good thoughts. How do you suss out the ambition of a founder when you meet them? You kind of get on the call. You're like, hey, let me tell you about Burst. I'm Mike. And you're kind of telling them a little bit. And then you're like, tell me about yourself. Like, how do you, because you get that like 5 minutes of like their backstory. What are you kind of looking for? When are you leaning in? When you hear something, you're like, I'm hearing what I like,
Well, it's certainly more art than science on that. I would tell you, like, I think people have attempted to create frameworks and rubrics and things, but I think there's a lot of, ultimately, that's where there's a fair amount of like intuition that has to go into it. Because some people say, okay, there's an accelerator, HF0. I just went to their demo day. They say, we only do repeat founders. And that's an interesting strategy. But you would have missed, Larry and Sergey, Mark Zuckerberg, Jeff Bezos, right? We can go down the list. You would miss a lot of pretty amazing founders that way. See, that is a strategy, but it's not the only strategy, right? So that worked really well. I think, look, it's a lot of things. I try and ask people to paint a vision of what the company is going to look like when it's a public company. I try and ask them a lot about their motivations, their childhood, like what is driving them to do this. To be honest, founders, and because I've been one multiple times, and I didn't, as a founder, stick all the way around to the like billions of dollars thing. I've seen how hard it is to have that fortitude because you have all these off ramps, you have these abilities to get out. And I stuck with Yelp. I kind of saw Jeremy Staubman, who went from founding all the way to multi-billion-dollar company, and what made him tick and stuff. And you've got to be a little bit different. There have to be some quirky things. If a founder is almost like too by the book, has the standard credentials and all that stuff, that oftentimes doesn't work. You know, what's funny is like I'm on the board of two companies right now where the founder, McKinsey consultants, like you're very typical. One of them, this company, OfferFit, the founders are also PhDs. And normally I'm like actually very skeptical, like, okay, consultants, PhDs, ivory tower, it's almost too orthodox, right? And so you really have to dig in. Is there something a little crazy or weird about this person that they're actually irrational enough to stick with this? Because they go make more money doing something else on a risk adjusted basis. And it's going to get really hard and irrational stay. But if they have that kind of dogged persistence to just keep fighting beyond what, you know, what they normally should, and they just have to build something so big. Anyway, it's hard to put one thing on it. There is
Yeah.
some pattern
That's the
matching.
art of it when you kind of meet somebody, and you and I have both been around some pretty amazing people, and you're trying to suss out that it factor
Yeah,
of,
the it factor.
you
Yeah,
know, sometimes I'll even ask, you know, what put that chip on your shoulder?
yeah,
You know, because I feel the force, like their force is
yeah,
coming right through the Zoom call at me.
yeah.
You know, it's like kind of like it's palpable. And
Boom.
I'm like, wait, what is this
With
I'm
the temp-
feeling? I almost feel uncomfortable.
Yeah,
You know what I'm talking
yeah,
about? When you meet a founder, you're like, I almost feel uncomfortable right now. Like this founder has a lot of energy, right?
absolutely. Yeah,
But it's not like a over the top bang you in the head energy. It's like a force.
yeah. Well, like, sometimes it's over the top banging in the head. When you met Travis Kalanick, it was right there. But other time, there's another founder of this company, Standard Fleet, that I invested in. So one investor met him, was like, man, he's got this nerdy gravitas, right? He doesn't come off as a Travis, but it's like you said, it's this force of like, he's just going at it, right? And he's really strong. But you're right, it presents in different ways, and that's, you can't just pattern match that there's just one way that they're gonna appear or act. There's a bunch of different permutations.
So you've gotten through the first 5 or 10 minutes of the call. This is almost like a water cooler chat between some VCs right now. And you realize it's not that founder.
Yeah,
You're 10 minutes into the call and you're like,
that happens.
it happens all the time.
Yeah.
You know, 90% of the time, you know, like a
What do
lot.
you do?
Yeah. What do you do? How do you get through that call? Yeah.
On most intro Zooms, if I'm doing it by Zoom, are 30 minutes. I try and actually do intro now. SF is back. I'm in San Francisco. So I do as many in-person meetings as I can, even for first meetings. It's hard. You know, usually, oftentimes I'll do a 45-minute first in-person, more just for social etiquette. Although if the person would agree to 30, I would actually like 30. Because I think for both of us, to your point, you're feeling each other out. You might as well just do 30 to just confirm that it was a good use of time. That way, so that's for starters. And certainly Zoom, first Zoom, I go 30. And so now you're 15 minutes in, let's say, you know, it's not working for one or either party, or it's not going to be a fit. You can kind of then, and it's happened with founders too, where they realize I'm not going to be, I'll give you an example. I'm not a dog owner, and I was looking once at one of the dog DNA kind of companies. And I went to their physical office.
Oh, I think I saw this one. Yeah.
Yeah. And I saw like there were dogs everywhere in the office. Everybody had a pet. And I was like, I'll be really honest. Like, what are the odds you're next? And I was leading, you know, with board seats at the time. So I was like, what are the odds your next investor or board member is like not a dog owner? Like, give me, you know, they're like, oh, that's actually very low odds. I was like, I got to be really honest. Like, is that, you know, you could just disqualify. Yeah, probably not. And so it might be them disqualifying you for, that's a kind of funny reason, but for a variety of reasons, right? Maybe you don't invest in their category or the wrong check size. They might not realize that till halfway through the call. Maybe either of you didn't do the vetting enough beforehand. And so if that happens, there's still an opportunity for both people to learn from each other and to help each other. And I try, you know, at Yelp, when I was doing business development, and I did business development for a decade at, you know, a few different companies at Stitcher, TrialPay, and elsewhere. It's
Really good training to be a VC. I mean, that's what I did at AWS and Microsoft was BD.
There you go.
You know, and it's like natural. It's almost like natural to go into VC
Totally.
after you do BD.
Totally.
Yeah.
I'm surprised there's not more of that path. It used to be, I think in the consumer internet revolution, it was like product manager to VC was the standard path, because it was like, oh, how are you going to assess all these products? But I think you're going to see more and more of this BD to VC path, because I think it makes sense.
You're already networking, you're having steak dinners, you're building those relationships.
You know how to do the relationships, and go to market is so important now for all these companies, and that's what you know how to do. But I would have meetings all the time. It's like, hey, we don't have a way we can work with each other, but there's still ways to learn from each other. And, you know, to build, I'm 15 minutes in. I try and be honest with them. I try and give a reason, you know, and I try and give something concrete.
In the first meeting.
Oh yeah. Yeah. I'll pass it. I think Adam Nelson, my former colleague at Social Capital, who's now at First Mark, I think he told me that from earlier. I was like, Mike, you know, if I can pass it, if I know in the first meeting and there's a way to do it, sometimes you can't really bring it up.
I chicken out and I send the email. I already know, but I send the email the next day.
Yeah. But sometimes you could just say, and it helps when you have a clear disqualification. Hey, you guys are too early for us. Like, it's just not going to happen. Or, now that I've got to know this is just a little bit out of focus. Like, or you know what? I just don't think I'll ever get comfortable that this market's big enough. I know believe in it, and I'm
You
not
should
trying to
believe it.
discourage
Yeah.
you, but I know for me, I'm going to get, so I try and anticipate what that past email or reason might be. And I just tell them, I'd be very honestly, it's me. Like, I just won't get there, even if, and I know you do. And then I'll say, but let's still, I'd love to learn. Like, can I be helpful? Maybe there's an intro I can make that could be interesting to you. Now that I'm probably not going to invest. If you want to share who else you're talking to, I can give you advice. Like, are you talking to so and so? Maybe there's this other person who's a better fit for you. I'd love to help that person in the remaining time that we have. And then that's a way to kind of turn it around where rather than a waste of time for both of us, I love helping people. So like, I got to help them. They were like, wow, Mike wasn't investing, but he actually like tried to be as helpful as he could. So anyway, those are some of the ways
I
I
like
handle
that. That's a really good advice. I learned something there. Thank you for that. Let's talk about growing E24. When you got involved, how big was it? I mean, I have here in my notes that eventually was almost $1 billion company and within a company.
Yeah. Yeah. So this was GMV, mind you. We had a take rate on that. There was a percentage of it. So the numbers sound like bigger, but we still had very, decent revenue. So like I mentioned, it was 150 million of that GMV. It was a few million when we met them, 150 million GMV when we did the acquisition. And then it got up to like 750 million gross transaction volume when around the time I left Yelp, which was 2 years after being at Yelp E24 CEO. And then, so the employees also grew from 150 to 500 employees that time. So it's always good. We're able to grow revenue and GMV faster than we grew employees. So that's a nice thing. But that was such an interesting journey because up to then I'd only managed a team maybe up to 20. And then I got thrust into managing over 100 people, growing to 500 rapidly. And so it's a whole, you're managing managers and directors and layers and trying to figure that all out. And it's a different,
doing all hands meetings and
yeah. So I learned a lot and it was good. And now I can really, it's fun as a VC because now I can kind of support founders through their growth. I've done the 0 to 1. I can help them to 1 to 10, employees and millions of revenue and all that. But I can also help them as they, that 10 to 100 million and 100 employees and beyond, how to think about all those phases.
Do you think you'd ever go back to operating?
No, I've hung up the jersey. I started when I was in college, I did all these software internships and then working full time, and I did a small startup. But I decided after grad school, I did business school, law school. I was like, I want to be an investor, and I went to Summit Partners to invest. But then I left because I thought, the best investors I've met actually had more operating experience than I did, and I wanted to just have more depth as an operator and founder. So I did that for a decade, longer than I thought it would. And now I've come back. Now it's like, I'm all in. Maybe I'll incubate, and Canvas, we've done that, where it's like, maybe I'll incubate companies, help companies get started, something that would be the most. You could be board member, chairman of the board, maybe, but actually being the founder, operator, I just feel, never say never, but very unlikely.
Yeah, that's how I feel as well. I mean, I was an operator for 20 years and did just about every job function, had a small business with 30 employees. Like, I cannot imagine going back and being a founder and growing a business at this point.
Yeah.
In my mid 40s. I'm over it.
It's a different, I don't think being a founder is just a young person's game. Like I think there's data that shows that these repeat founders actually in like late 30s or 40s, whatever, are like an excellent cohort, maybe the most outperforming cohort. And all that said, it's a young man's game. Like from my perspective, like for me personally, that was from the younger version of myself. And luckily I realized that when I was doing Stitcher, I was like, I have no mortgage, no kids, I'm risk on, I can do this crazy thing. I think when I left, venture capital, private equity as some partners, I think my salary got reduced by more than 75%. Like, can you go down? One thing I help founders sometimes as they're thinking about managing their burn and stuff. I was like, I lived in a nice 1-bedroom apartment in the San Francisco Marina. I had a nice car in my garage parking spot. It's like sold the car, downsized to a studio, lost my parking spot, like squeezed out, bought a used bicycle as my primary meet and a bus pass. And I just like reassessed, went bill by bill, canceled my cable TV, like ramen profitable, living off ramen and mac and cheese. It's just like, let's do that. And I could do that in that phase in life. Not every founder has to do that. Repeat founders are usually in a luxurious position. They don't have to. But I don't want to, it's just not for me right now.
That's amazing. You got to do that. You got to go risk on in your 20s and early 30s before you have a family and mortgages and stuff like that. You have such a storied, deep background in marketplaces. I'd love to pick your brain on what you look for in a good marketplace business. I mean, one would probably think, hey, hasn't this all been done? Like, it's a marketplace for dog walking and it's a marketplace for this. What do you, and I've invested in some. I have that in my thesis. I love marketplace businesses because if you get them right, there's just such high durability and network effects in them. Like how do you assess them in that kind of seed stage?
So first of all, I've got this marketplace checklist that I go through that
I need the checklist.
has different criteria, right? So, and I've done a blog post and stuff on this. But, some of the things, there's some of the obvious stuff like, okay, what does supply look like? What does demand look like? What does liquidity look like? How often are people transacting? What's repeat behavior? What's transaction size, transaction frequency? But there are some interesting questions that some founders, sometimes I meet them, and it's fine, especially at seed stage, they haven't even asked themselves this question. Like, what side of the network values the other side more? So I had been fortunate to study marketplaces under the name of networked businesses, right? They're two-sided networks in business school when it was still kind of an early area of academics. There's this professor I had, Tom Eisenman, in business school, who was studying these things in the early 2000s. So I was lucky to just kind of get in his class. And that was one of the really interesting questions. So like with Uber, they're paying $20 coupons to get new riders on the platform, but they're paying $500 guarantees to get new drivers. You can pretty quickly tell, like the more valuable side of the platform is the drivers, right? The riders need the drivers more than the drivers need the riders. And I saw that when I was trying to partner at Yelp with Uber. I went to their head of growth, right? And I said like, hey, do you guys want to pay us? We could have like a nice like route to with Uber, route to your location with Yelp, but we'd want to get something in return. Maybe, give us some rev share or give us some other thing. And he was like, no, look, I don't need riders. I'm the head of growth, but I can't pay a dime actually for riders. I need drivers. I'm spending all my time, even though I'm supposed to grow the rider base, because every driver I bring is going to bring that many more, like a multiple of new riders. So you've got to know where your and look, you shift over time from having your bottleneck be supply or demand, and it changes. But usually over the arc of time and a longer time horizon, like with Uber, it becomes apparent that they're constrained on one side. With Uber, that was really supply constrained on the driver's side. So they have to put so much effort into getting that right. And that's what they figured out. But some other businesses are demand constrained. So anyway, these are all the different things. I've got the whole checklist I go through and you figure out.
Yeah. We'll link that in the show notes. I'll find that
Yeah.
and link that on your blog. That's amazing. And I'm going to add it to my due diligence checklist for marketplaces when I'm looking at that. I think that's great. Do you see any way, we talked about the AI being a platform shift. Do you see it transforming marketplaces in any way?
Do I see AI transforming marketplaces? Absolutely. So I think that's the thing is I think we had a marketplace wave and boom with Web 2.0 and mobile with this Airbnb, DoorDash, Instacart, Uber, all these companies, and Yelp. I think now we're going to see the AI wave of marketplaces. But since it's not this obvious hardware platform, like we said, it's more like internet, it's more nuanced. People still are figuring out how intelligence creates this platform. There's the obvious use cases that everyone has now, but there's all kinds of use cases we haven't thought of yet. I think it's not obvious yet. It doesn't fit into a cookie cutter box the way there was a while where it was just Uber for X. And you could just do that in every category. And that kind of worked. Like Uber for food delivery was DoorDash, Uber for grocery delivery, Uber for homes is Airbnb, Uber for cars was Turo, like for actually, getting. So then there were some categories that didn't work. There was Uber for private flight, like that never worked out. But there were the
Why do you think it didn't work out? If you're an investor looking at that, kind of going through your checklist.
Yeah. Private flight repeat was low. The mass market adoption potential was low. There was safety and other risks. The scheduling part, it was hard to make it truly on demand. It was like you had to schedule with the FBO and all this stuff. And it wasn't really, so it didn't have a lot of those aspects that can really make a marketplace zing, which are like for Uber, like ease of consumer use. That's what unlocked for Uber is like Uber wouldn't have been possible till you had that mobile phone in your pocket and you could press a button, see the car, comes right away. So, you had this unlock of a much better user experience.
It's like an order of magnitude friction removed almost. It's
totally.
Instead of calling and I don't know if they're going to come and the repeatability and I constantly need to do this. We struggled with this because I was BD at AWS Marketplace. I led AI there. And then I went and led all the team over at Azure Marketplace. And we always struggled getting the marketplace dynamics right for enterprise software.
Yeah.
Because there's not a lot of repeatability. There's a lot of leakage here. It's like, why should I transact and give you any take on it? And it was always a struggle to try to get that going. And they did get it going, but it was like, you almost had to pull people in kicking and screaming into that marketplace.
Yep.
That's funny. So thinking about like, you guys are in fund 2. How involved were you with fundraising, for the VCs listening out there and people like me about to raise another fund at some point in the future? What did you learn in raising a couple funds? When did you raise them? And what did you do differently in fund 2? And what would you do differently in fund 3?
So I was involved with Burst fundraising as an advisor, and because I've been close with the Burst team, for 15 years, it even started. But I actually, I was at Canvas when the first two Burst funds were raised, and then now I'm joining Burst in Fund 2. I helped raise the last Canvas Fund 3, and then I helped out with Burst a little bit more from a distance. There's some of the obvious advice. You've got to know how you're different. You've got to have your reason to exist, or some kind of differentiation. Just like when you're looking at startups, right? It's the same thing. Like, why is this going to stand out? Why is it going to be different? There's got to be a reason to believe. The LPs have to believe that you're going to win deals. You're going to have something proprietary, both maybe a proprietary network, but also a proprietary view on things, ability to attract these founders in, get access. Because ultimately it's like, can you source and get access to these best deals, find them? Then can you pick once you have that access and you're in? Then can you win? You picked right, but do they want to work with you? And then can you build if you're going to take board seats or help? Like, are you going to help the portfolio and then get more referrals and get that flywheel going? So LPs are just assessing, do you have an edge there?
Yeah.
I think for emerging managers, it's a lot more about high net worth individuals, maybe family foundation, friends and family, getting off the ground, smaller checks. They might not be able to commit to you like multiple funds. They might come in on the first fund, maybe the second, third, maybe not, because it's going to depend on their personal financial situation and liquidity for a lot of high net worth individuals. As you grow, then you start transitioning to institutional. That's very different. A lot of institutional, they might have emerging manager programs, but a lot of them want to, invest in Fund 2, Fund 3, and beyond. And an established team who has a track record, who knows how everything is working. Ultimately, the best thing to do is like find great companies and drive returns. And if you can show at the very least, TVPI in the form of markups, and even better DPI, actual cash returns, that's what LPs are looking for. And then everything else is like early indicators that are going to feed into that.
I don't know if you peruse the TechCrunch headlines every day like I do. I forget who it was. He was like, VC is dead right now. There's been no DPI for like 4 years.
Yeah, it's hard.
Yeah, maybe
But,
with
we've got some. So there was one company, OfferFit, announced M&A today in our portfolio. So that's going to end up being DPI once that's fully closed. We had at Canvas, there was Case Text sold for 600 million. There's Gabby, another one where I was on the board as well, sold for 300 million. So like exits are still happening in this environment. They're not the big multi-billion-dollar liquidity events typically as often. Those obviously with the ways like that does happen as well. It's more rare. But you take even the sub-billion-dollar kind of exits, if you can get those 9-figure kind of situations, that's still really interesting. And I think LPs understand that some of the hits are not going to be as big right now, but the fact that you can show liquidity is interesting too. The counterpoint, the trick is you don't want all these companies selling short. You also want to bet on companies that will go the distance. So it's a balance.
Yeah. Let's talk a little bit about the future. So there's this recent shift kind of in startups towards capital efficiency, profitability. How does this change how you evaluate startups? Do you think this is a healthy shift, or do you think this is just a kind of a sign of the times, given that capital's been kind of constrained over the last couple of years and things will go back to, grow at all costs?
I certainly think it's a healthy shift. I think that I'd always been looking at, responsible burn type companies. I got uncomfortable. There was a time with Uber where you used capital as a weapon, and that really worked well for them and for some others. But they were still a pretty financially disciplined company. It's not like, that's the thing, is that I think for every one Uber, other companies looked at that and were almost just burning for the sake of burning. And those kind of companies never succeeded. So I do think you needed a correction. And like Uber, you had general managers in every market who were super intelligent, highly vetted in a like 1% admissions rate interview process, carefully looking at their metrics. So even if you're in hypergrowth mode, burning a lot, but you have very clear metrics and you're responsible around how you're doing it, that can make more sense. But I think for most founders and most companies, you should be looking at your burn multiple. You should be looking at capital efficiency. You shouldn't be just going around trying to burn $2 to make one. That just doesn't make a lot of sense. So I think obviously you have to invest in growth. We don't want to go back to a time where people are only drawing off their own profitability. That's the whole point of venture, is to let you try things that require investing up front because they'll pan out later with larger rewards. But I do like the current balance that I see being struck more often between responsible investing by founders.
Amazing. I think I've seen this over the last, I've been investing not as long as you, maybe 7 years and 5 years with other people's money. I definitely see a shift in capital efficiency. What is a good burn multiple that you're seeing now in kind of seed and A?
I mean, I mentioned Jeff Fleur from Kraft. I think they had a great framework for this, which is like 1x or less is kind of great. I think it was like 1 to 2 or 1.5. Someone there was like good. And then less than 2, or sorry, higher than 2 burn multiple is kind of questionable. So there's different ways people define it. Some people do it off like total revenue, but the purest way is like, what did you burn last year or last quarter? And then how much new ARR? And that's for, SaaS businesses. Everything is a SaaS business, so you got to look at it different ways. But let's say a SaaS business, like how much net new ARR did you create with that burn? And I think it's a great measure. So not everyone can get below 1. And so you see a lot of companies coming at like between 1 and 2. You see some companies in the very early days have to go higher than 2, but you at least want to see a plan that they're trying to get south of 2.
Yeah. What about in marketplace businesses? How does that change the equation?
Yeah, I mean, I encourage, there's a lot of marketplaces that try to just have no monetization at the start and just only have GMV and they don't have a take rate. And I really discourage that. I say as soon as you can, get the take rate, show that you can generate revenue, because a marketplace without a take rate isn't really a marketplace. It's more just like a
Connector.
matchmaking service.
Yeah.
Right? You showed it's like a directory maybe, but you haven't shown that you provide value as the marketplace. And then some people are like, oh, well, we'll just start out, we'll capture 1%, 2, 3, even 5%. If you only capture 5%, credit card companies basically do, it seems like nothing, right? I mean, they obviously provide a service, but they're capturing 3% for doing hardly anything. If you're taking 4 or 5%, if you're barely more valuable than the credit card issuer, that is a concern from it, that you're like, hey, we're just like Visa. That means your app, your product, your service doesn't do much. If you can show that you can at least, like Uber and others, like if you can at least take 10, 20% up to maybe 30, now you're like, hey, we create some real value. Above 20 to 30%, like certainly above 30%, now you're probably taking too much actually, and you risk disintermediation. So there's a Goldilocks amount. But we look for that real revenue, and then using that real revenue creating, you can actually look at a burn multiple on that. You might give marketplaces a little more leeway to grow into it, but by Series A or B, they should have a responsible burn multiple also.
So you're looking at net, the take rate versus the burn.
Correct.
In this case, yeah, that 15 or 20%.
Yeah.
You've been in venture a long time. What's one contrarian view you hold about the future of VC?
I don't know if it's contrarian or not, but to me, it's fairly obvious that investor is one of these categories that's high up to be disrupted by AI. Like, I think there's some VCs.
I worry about this a lot, actually.
Yeah, but here's maybe what's then double contrarian, but I don't worry about it. I'll tell you why I don't worry about it. Not that I don't think it's going to happen. So I think some VC's response is like, no, there's this judgment and the human side that's so important. But I don't know if you've ever played an iPhone game called Paperclips. It's based on this Nicholas Bostrom, this philosopher, AI guy. Yeah. The most popular AI philosopher is Paperclip.
Yeah, the Paperclip game where you're trying to
make all this paperclip get an investor algorithm, and your investor algorithm gets good enough. Like, to me, that all of a sudden your investor algorithm gets so good, you're just printing money and you make way more money off your investment thing than off the paperclips themselves in this little game. To me, it's not rocket science. Of course, like humans do this pattern matching. Computers will be better at it. They'll do better at first at public markets, commodities, and other things that don't require as much like face-to-face. It'll be harder in private and illiquid markets at first. But eventually, and we tried to do this a little bit at Social Capital with Capital as a Service. That was kind of like V0.1 of this in the pre-AI era. But I think this will happen. I'm just not afraid of it because I think I'm just here to embrace it, use it. I'm kind of accelerationist in that way. And I think I can work around that new reality and find a way to be economically valuable, even though the machine is maybe doing more of that picking piece. There's still other pieces. They're like, hey, let me help you grow as a company. Maybe that coaching also gets out AI, but I think I can just continue to find the gaps where the humans need help kind of bridging to the machines. There's a great book on this called Average is Over by this economist, Tyler Cowen, that was written before the AI boom. And it's just so fascinating. Kind of, he really predicted all of it, that the people who understand how to work with the machines and use it, like they get it. That's why I go on Replit and try and like make apps. You always want to stay current on using the latest technology and using AI in your job. And then I think you'll always find a way to create value.
Yeah, I love that. And the example is like chess, right? Deep Blue could beat Garry Kasparov, but now the best chess players in the world use AI.
So that's actually in this book. He's talking about freestyle chess players who can use the algorithms, right? And you can be better than any one algorithm if you've got all of them at your disposal and know how to use them. Kind of like people using multiple foundational foundation models to figure out which one can answer best.
Yeah. And we basically run all of Team Ignite on ChatGPT at this point.
That's awesome.
I got to try Gemini 2.5 because it just came out and it's so good. But basically, our entire business, every workflow, every deal, every deck, every due diligence, everything flows through ChatGPT. It doesn't make our decisions for us, but it just makes us more efficient. And it gives us, it helps us spot things.
Yeah, very cool.
The human still makes the final decision, but you get to talk to this like PhD level assistant that can be like, what about this? What about that? And did you ask him about this? And take the whole Fireflies transcript, plug it into ChatGPT.
Yeah.
What did I miss in this conversation?
That's great.
Yeah, it's pretty cool.
Yeah.
Why don't we wrap up with a rapid fire?
Sure.
What's one startup idea you wish existed but you haven't seen yet?
One startup idea that I wish existed that I haven't seen yet. I'll tell you one basic one I've been looking for. It's like very simple. Lindy is kind of doing this. Like, why don't I have an AI email assistant? Lindy requires a lot of custom configuration, so that's one challenge. But how come I can't just easily email, like CC copying, just like you might copy an executive assistant who costs, $100,000, $200,000 more? Why can't I just copy that assistant and have it do everything for me?
I've tried a few tools. It's hard to get right. It's so hard.
Yeah. But I think the dead simple thing, ChatGPT could just do this. Why can't you just email and get answers to ChatGPT queries about? You can't even use email as a medium of communication with any of the big models, which that's like the low hanging fruit. Yeah. If you find a way, please get back to me and let me know.
Yeah. You immediately tell me if you use something, because I've tried a few things. I almost invested in one coming out of YC recently.
Okay.
I tried it out. I was really excited. And then after a few days of trying to get it to work, I was like, this is not there. It's just not ready.
Yeah.
I need the full rag of like all the tens or hundreds of thousands of emails indexed so that it can
that would be really nice. I don't even need that. I could just use a plain old model over email, but if you found that one, let me know. So
I've actually started copying and pasting. So I'll get an email. I'll just take the whole chain. I'll plug it into ChatGPT, and then I'll press Windows H because I'm a PC user.
Yeah.
And I'll talk to ChatGPT and I'll say, here's what I want to say.
Yeah.
So I don't type it out, because you could type it like 100, 150 words, and you could talk at 200, 300, 500 words. And so now it just spits out this beautiful email. So it's made my emails much more comprehensive and verbose. I don't know if they're better, but it just helps me.
Yeah.
Get the email out.
I just want to be able to CC the email. I don't want to copy paste anything. I just want to CC and get. So anyway, we can go to the next one.
Yeah. Call me immediately if you find that.
Okay.
What's a common mistake founders make when pitching VCs?
I'm not sending the deck in advance. I was just talking about, they want to do the grand reveal. For most VCs, we got into VC because we're either officially, I'm not, ADHD diagnosed, but we're all.
I think we all are a little bit on the spectrum. Yeah.
Yeah. And we need to flip through your deck, on the call. The problem is, if you're going to present it on Zoom or whatever, and then send it after, because in the old days, in the previous generations, they would have a paper copy, and at least in the meeting, you could flip through it. Because the VC wants to go back and forth. That's good for you if they're digesting your material in a non-linear way. Forcing them to linearly traverse exactly how you think. They don't think like you. They're a different human being. So anyway, the deck. So you could, if you want, send the deck 10 minutes before. And if you send it during the call, you've got to fumble around. They've got to fumble to download, see, can they access. So at a minimum, an hour in advance, but honestly, 24 hours or more in advance is just even better.
I love that.
The other thing is even better to save your time and their time is before even having them agree to the meeting, send it. And that way, if they don't want, if it's not a good use of time, they just will save your time. It saves you a lot of time. They just won't meet with you based on the deck.
I actually have multiple layers of this. If I get an intro, depending on who it's coming from, I'll ask for a deck first before I take the meeting. If I get an intro and I know it's pretty shitty deal flow, I'll send them to an Airtable form, which asks them a bunch of questions, and then that gets crunched with AI.
Yeah.
Then I maybe take the meeting, and usually I don't, because if I have to send them to the Airtable, it's probably not a good deal.
Yeah.
No offense, startup founders out there listening.
I was going to say, now if someone gets sent to the Airtable, they're going to be like, wait.
Yeah, I went to the trash can here. I think another mistake that really bothers me is putting it behind a DocSend, but not making it downloadable.
I do think it's a mistake. The whole VC work infrastructure works on being able to do stuff with these, and you might want to AI analyze it and get a summary and stuff like that. So yeah, I think downloadable is a way. Again, you don't need to put your state secrets in there and all this stuff. You can have an abridged version, but having something, everyone should have a BD or a sales deck that you would feel comfortable posting online anyway. So that deck, you should be okay with everyone downloading. And maybe there's a couple extra slides in there for the VCs, but an overview deck shouldn't be a big state secret. If it's, the common wisdom is if it's that easy that you're worried a competitor would copy it or whatever, if they had it, then there's not enough defensibility.
Let me ask you this. I just had a founder run due diligence, and this is a standard due diligence question I ask, which is like, hey, can you send me your last few investor updates? Like, I've made an offer to invest. I'm in due diligence, right?
Yeah.
And I'm like crunching through the data room. I'm like, I don't see your investor update. And he's like, well, those aren't for you. You're not a current investor.
Mm.
I was like, what? Do you think that's a red flag or?
That's an interesting point. I usually haven't asked for them, so I don't know if it's a red flag.
Yeah.
I would say it's not a red flag just because they're not used to sending that as part of diligence. I don't think it's standard. It's not in the standard diligence pack. Maybe it can be, but I don't think it's like required. It's a good idea. I will say for like at Series A or B, I used to say, hey, can I see the last couple board decks? And I prep any founder I'm working with as they're doing board decks. I'm like, be ready. These are all like discoverable in diligence. These will come out, but they're probably most of them are not thinking that on their investor updates.
Yeah. Maybe that's what he's thinking. It's like, I was pretty revealing in these past updates and I didn't expect to give them to you.
Heart to hearts.
Yeah.
Like saying who he was meeting with in the investor pipeline and stuff.
This Team Ignite guy seems like a joke, you know.
I probably would give, exactly. I'd probably give a pass on that, but I see where it's coming from. It's a decent thing to ask for if they would share it. Yeah,
I like to read them. What's your favorite marketplace business model you've seen recently?
My favorite marketplace model. So one that I really like is Float Health, a company I'm on the board of. So it's a nurse marketplace for like in-home nursing care, which I think is just a huge market in general. On-demand in-home nursing, in-home healthcare. But this one's particularly interesting because they're a wedge. Their initial market, we're talking about market size, is already so large on immunotherapy, IVIG. So this is immunotherapy, life-saving therapy for patients that has to be done through like intravenous. And historically, you go to a clinic, a nurse is monitoring you. You can't just do it on your own at home, take a pill, whatever. So you have to go to this clinic. It was a huge pain. These people have to go once a month for the rest of their lives in many cases. It saves their life. They live long, healthy lives by doing this, but it's expensive, costly, and time-consuming. And so if somebody can come to your home with the right equipment and do all that, and once a month, so now if you're a parent taking care of your child, like you don't need childcare, you're just like at home watching the child. If you can work from home, like you don't need to like take a day off work. You're still at home, you're on Zoom, you're doing stuff, and the immunotherapy is just going, and you can work. Like it doesn't make you sleepy or anything. So it's pretty amazing. It's kind of like the Uber thing of unlocking a 10x better user experience by creating, this marketplace. So I think Float Health is fascinating. The founder, Ryan Johnson, is here now in San Francisco, and they're growing really fast.
Amazing. Well, I could talk to you for another couple hours. Where can folks find you online?
On Twitter, I'm at New Mike. And then on LinkedIn, you can find me as well, just by searching my name.
Why New Mike? Why not, old Mike?
The old Mike is out. So I have to, get New Mike.
The real Mike.
Yeah.
Well, thanks so much, Mike. Really appreciate it. It was a really fun conversation.
Really fun. I appreciate the time. Thank you.
Thanks.